China has just sold a staggering $113 billion in US debt, sending shockwaves through the financial world. Is this just another step in an ongoing rivalry, or does it signal a seismic shift in global economic power? What's really at play here, and how could it shape the future of the global economy? But what even is the US debt, and why are China and Japan selling it? Before we dive into this fascinating financial chess match, please remember to hit that like and subscribe button. So when the US needs money, which is basically always, it sells Treasury securities, basically IOUs. Countries like China buy these IOUs because they're usually a safe place to park cash. It's like lending money to your friend who always pays you back on time. Over the years, China became one of America's biggest creditors, holding close to $1 trillion of US debt. But now, things are changing. In the recent past, Japan and China have made moves which has got the entire world talking. Japan sold US Treasury securities worth $61.9 billion, and China sold securities worth $51.3 billion. This is the second biggest sell-off China has ever registered. To put it clearly, China has reduced its total US debt holdings to $774.6 billion from $1.27 trillion, a decrease of nearly 40% over the last decade. But here's the real kicker. This is not a one-time event. Since 2018, it has been part of a larger, more comprehensive strategy that China designed and is now executing. So what's the reason why these two countries are selling US debt obligations? China economy has always thrived on trade, with one of its major model being export-led growth. This means that it must not be a pushover in the marketplace and must manage its currency properly. By getting rid of US debt, China is able to more easily manage its currency, the yuan, especially with a trade deficit level of $27.9 billion between itself and the US as of August 2024. But it is not simply trade that matters. China is also addressing the risks of the US monetary policy. They do not want to be affected if the US interest rates aren't stable or if the dollar has wild swings. However, this move is not just about protecting itself from changes in US. It is also about addressing some huge problems that exist within the country. China's local governments have huge debts totaling $5.6 trillion. In a bid to salvage this ticking time bomb, the government of Beijing launched a rescue package of $1.4 trillion. This includes actions such as increasing debt limits and also selling bonds, which are unique due to their nature and are meant to reinforce the economies. These are attempts to avert a collapse of the financial system, but they also show how much stress exists within the economy of China. At the same time, through the sale of debt to the US, China is in a way able to free up more funds. Rather than investing in the bonds, China could use those funds for strategic problems within its economy. Japan has also the reasons, albeit different, for offloading US debt. Japanese investors have started to shift resources into higher domestic bond yields. When higher yields are available, the US Treasury tends to be less appealing. Furthermore, Japan's financial markets are working through an uncertain global stage, and their investors have to rethink their plans. Such moves by China and Japan will not affect solely China and Japan's economies. Currently, Treasury yields in the US have experienced multi-year highs, and bond values have lost nearly 4%. To put it in perspective, the higher the yields, the greater the borrowing costs that will be borne by all the governments, businesses, and consumers taking loans. The market sentiments created by this sell-off also have a political dimension. China in particular is using its actions as a gentle way to show off its economic sovereignty. China is indicating that it wants to be in charge of its own economic future by decreasing its dependence on US debt. Despite these sell-offs, China and the US remain economically interdependent. The US is a key export market for Chinese goods, while China is the source of inexpensive consumer products for the US in order to keep inflation in control. It is a brittle structure where both powers are like two strong boxers moving in ring, as they know that a knockout could have a lot of repercussions for both. China's dollar holdings in US Treasuries represent only 2.9% of the national debt of the USA, which stands at $35.74 trillion. This is a tiny portion of the wider picture, and therefore, it is hard for China to create upsets on a wide scale. However, the long-term prospects are quite serious. China's ongoing decrease in US debt holdings does not mean that it is trying to cause a financial earthquake. Its aim is to provide options for itself. China's approach is long-term since it reduces dependence on the dollar and increases its asset diversification. The strategy intends successive self-sufficiency in case the US decides to impose sanctions in the future. Amidst all this financial drama, America and China are locked in another high-stakes tussle over technology and trade. From semiconductors to rare earth minerals, both nations are vying to acquire the key materials and technological superiority. China is also trying to develop its homegrown technologies and reduce its reliance on the West. Areas such as artificial intelligence, quantum computing, and renewable energy are central to the campaign. Another one is the Belt and Road Initiative. By developing infrastructure and economic relations, China is establishing other global networks across Africa and Europe, thus providing options besides the current Western-led order that they are trying to overcome. That being said, what does all of this mean for an ordinary person? Mortgage rates and the cost of business loans can be easily affected by moves in US Treasury yields. If the costs of borrowing increase, it is likely to inhibit economic growth. These policies also have a great global context, as they are changing the world economic order. Countries such as India, Brazil, or Indonesia are trying to take advantage of the current trends in the relations between the US and China. This, in turn, presents a possibility of new chances and problems for industries and labor around the globe. There are those who tend to depict the US-China relationship as one characterized by conflict. However, such a notion would be misleading because the relationship is quite intricate, similar to a vast web of mutual dependencies. Each nation stands to gain from their economic relations, even as there is a clear vision of the future that speaks of a reduced need for such ties. It is correct, however, to state that technology will be the new front. The developed technologies of artificial intelligence, renewable energy, and other innovative industries will mark the next generation of global economic hegemony. The balance of power will greatly change in favor of the countries able to emerge at the forefront of those industries. Whether it's through financial markets, technological innovation, or global trade, the decisions being made today will shape the world for years to come. In conclusion, the recent massive sell-off of US Treasury securities by China and Japan signals more than just a routine financial move. It represents a shift in global economic dynamics. China, in particular, is reducing its US debt holdings as part of a broader strategy to strengthen its economic sovereignty, manage its currency, and protect itself from the risks associated with US monetary policy. While this move reflects internal economic pressures within China, such as massive local government debt, it also highlights China's long-term goal of reducing its reliance on the US dollar and diversifying its assets. Similarly, Japan's actions are driven by a shift in its financial strategy, with investors seeking higher domestic yields and adjusting to global uncertainties. This reduction in US debt holdings by two of the largest foreign creditors is having ripple effects on global markets, contributing to higher US Treasury yields and potentially increasing borrowing costs worldwide. Despite these financial shifts, China and the US remain economically interdependent, with both countries heavily reliant on each other for trade. The relationship between the two powers is delicate, with the economic actions of one often impacting the other in significant ways. The future of this relationship, however, is likely to be influenced more by technological competition and geopolitical maneuvers, especially as both nations seek to lead in emerging fields like artificial intelligence, renewable energy, and quantum computing. Ultimately, the ongoing changes in US-China relations and their impact on global economic structures are not just an academic issue, but one with real-world consequences, from mortgage rates to global trade dynamics. The coming years will determine how countries adapt to these shifts and whether new economic alliances will emerge in response. The question is, how will we adapt to these changes? Let us know in the comments section below, and make sure to like the video and subscribe to the channel. Thanks for watching.